Are you wondering how long your money will last in retirement? That's the million-dollar question. In this video, I'm going to show you exactly how to see how long your money will last in retirement based on some assumptions that we're going to make. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about my investing adventure over the past 40 years or so, along with creating multiple income streams over the past 15 years, along with my husband, after we stumbled into early retirement. In this video, I want to take you through a process, a calculator actually, on retirecertain.com, where you can see how long your money will last in retirement. Now, before we get started and before we go over to my computer, I want to just point out that this is based on assumptions, right? Nobody knows exactly what's going to happen in the future. In fact, we kind of don't have any idea, but we can make some assumptions based on what's happened in the past with our investments. The first thing that will be a huge variable for everyone, because I can't say how long your money will last in retirement. No one can. No expert could ever tell you that, because it totally depends on how much money you have, how much money you spend, what age you're going to retire, and what sort of rate of return you get on your investment accounts. Those variables are going to be different for everyone. Those factors will be different for everyone. So those are things that go into retirement planning, and even though we can't know for sure what's going to happen, once we sort of can estimate those based on our current spending habits and what we really want in life, then we can plug some numbers into the retirement calculator. So I'll see you over at retirecertain.com. I'm headed to my computer. So here I am over on my computer at my website, retirecertain.com. And if you come to the home page and you see this drop down here for calculators, just hover over it. You'll see Run Out Calculator. I've got several calculators on here if you want to play with the different ones. And I've also got a lot of articles and information on here. So I'm going to click Run Out Calculator because that's what we're going to look at. And again, there are some assumptions that we have to make. The top part of this calculator has the things that aren't assumptions. They're hard, cold facts about how much money we've saved and also about how much money we're going to withdraw. So those are things that we can control. And then down here, we're going to make some assumptions. And one of the big problems with retirement planning is it's based on a lot of assumptions. Investing is based on assumptions. That's all we have. Assumptions and really estimates are what we have to work with. And the main thing is that we take advantage of those assumptions and estimates because we can estimate fairly reliably, not completely because we just don't know what's going to happen, but using estimates is so much better than not using estimates, because if we're not using estimates, then we have absolutely no idea of how long our money will last, and we have no idea how much money we can save, which are some other calculators on here. But in this case, we're going to go with some assumptions, and we'll talk about that as we enter the data here. So you can come over and put in any amount you want. I'm just going to grab a 500,000 here and type that in. And let's say you've saved 500,000. And let's say that your monthly withdrawals will be $2,000. Let's say you've gotten some other income streams going, maybe some real estate, or you're doing some consulting or small business. You know, I love diversified income streams. I think they're the saving grace for everybody that hasn't saved enough for retirement. And there's so many opportunities now for extra income streams. So let's say you've got some extra income streams and you're only going to withdraw about $2,000 a month. Maybe you're old enough to have Social Security. Everybody's situation will be different. As you're doing this, think about how much you're spending now and think about, is it really going to be enough to live the desired lifestyle? Anybody that follows me and reads my newsletter knows that I'm really big on first clarifying what you want and then looking at how much you're spending right now to live and adjusting that up or down. I'm not all about cutting expenses in retirement, that time when we finally have an opportunity to do something that we really, really want because we have the time to do it. I'm not about scrimping and just, I'd like to go the other way and see how we can use our skills and or invest better so that we can have enough money to live how we really want for all of our life. So having said that, let's just assume that you've got some other income streams going, and that's what this whole website really is about, our journey for creating other income streams, if you want to take a look at some of my articles. Now let's move down to the assumption area. So what's this yearly withdrawal increase all about? Well, that's about inflation. As you probably know, if we spend $2,000 this year for something, we won't be able to buy as much with the same $2,000 next year if history continues to repeat itself, which is we have inflation almost every year. Historically, inflation has been about 3% over very, very long periods of time. And more recently, in the past decade or two, it's been closer to 2%. It's predicted that inflation will rise. Sometimes sometimes when experts predict things, the opposite happens. But let's say that in this case, what I like to do is use the historical number. So let's just use the longer term historical number. I like long-term historical numbers, going back as long as I can get the data, 4 decades, 5 decades. That's what I use in my investing. I look back as long as I possibly can. So let's go with 3%. And the reason it's so high at 3% is because in the early 1980s, inflation got over 13% in 1 year. Can you imagine if next year you could buy 13% less with the same amount of money as this year? So you can see how important this is. So let's go with 3% here, and that will increase every single year because that's what inflation does. It depletes the buying power of your money. Then the next field says savings interest rate. And what that really is your projected return on investment. A lot of calculators call it savings interest rate. I don't know why they don't put return on investment. Maybe it's some kind of liability issue. I don't know. But anyway, this is how much you think you'll earn on your $500,000 capital every single year. So you can see how if you withdrew less than you earn, well, you're going to come out okay. And that's kind of the goal with retirement. Most retirement planning really involves, though, spending down this entire $500,000 or whatever your savings are. And it's kind of centered around depleting that down to nothing. That's kind of how retirement planning works. I don't like that thought because I don't like that plan, I should say, because these assumptions down here, we don't know what these numbers will be for sure. So hence the extra income streams to support us so we don't have to withdraw so much, or we can defer withdrawals until we're a little bit older. But having said all that, the return that we're going to put here, again, is an assumption. Historically, the stock market has returned about 10% on average over very, very long periods of time. But we have to remember that the NASDAQ, for example, dropped about 78% during the tech bust. So that was a lot of investors were heavily invested in technology stocks and the NASDAQ index. The S&P 500 index dropped about I believe it was 56% in the 2008-ish bear market. So some years go down, some years it goes up. Really long averages, it's been up about 10%, but that's just for stocks. And most people will diversify between stocks and bonds. That's a whole other topic that I won't go into. I'll just say that some experts that I respect have said to plan on about 4% going forward for this return number. What you really have to do is look and see what's happened in the last few years to get an idea of what might happen going forward. And believe it or not, the better and longer the stock market has been performing, the more likely it is it won't perform that good over the next few years, and vice versa. So let's take a wild guess here, and let's say that you're going to earn about 6%. I'm not saying you can. I'm not saying that's what I earn. I actually am planning on about 10%. I'm a very proactive investor, and I use a tactical investing strategy based on historical data. I'm comfortable with that estimate. Most people are invested in passive stock and bond index funds, and I think 6% is a good guesstimate right here. So I'm going to use that. Again, we have no idea about taxes. We just know that on a historical basis, we're really, really low for taxes in the US based on what taxes have been during other decades. So I'm going to just put 15% here. Again, so many variables, and it also depends on the structure of your accounts. Maybe you've already paid taxes on this money and you won't owe money, and you're just withdrawing your money that you've paid taxes on. That, there's just so many variables here. But let's just go with 6%. So we've got 500,000. We've got monthly withdrawals of 2,000. We've got inflation, expected inflation, or we're going to increase that withdrawal every year by about 3% to keep up with inflation. And we're hoping that we'll get about a 6% investment return during this time frame. And let me also mention that this calculator is based on 30 years out. So it would be suitable for someone looking to retire in their 60s, late 50s, 60s. Really depends on your life expectancy and what you want to go with there. I'm planning on living well into my 90s and being healthy until then. I like to project out at least 30 years, if not longer. I also don't want to run out of money in my 80s. So this calculator projects out 30 years, just so you know that. And then I'm going to submit, and it will tell us if this $500,000 will last for 30 years. If we withdraw $2,000 a month, we increase it 3% a year for inflation, and we earn 6% on our money, and we do have a tax, we have to pay taxes of about 15%. I'm going to submit, and the explanation of the results is that your money will last approximately 28 years. So it was close. It almost lasted 30 years, with systematic withdrawals totaling $1,023,000. Now you may be going, well, wait a minute, we only had $500,000, right? Well, this is the beauty of compounding and earning investment, that return that we had in there of, I believe it was 6%. We actually would be able to withdraw over $1 million over 28 years if we systematically did that. So come over here, play with the calculator. You can change these numbers up, put in $100,000, $5 million, whatever you want to put in here, and play with these numbers. Look and see how much you're spending. Look and see how much you think you would need to withdraw from your savings, and see how long your money would last in retirement.